Hello everyone, welcome back to Fundrise Finance. In today's video, we go over a few companies which just announced dividend increases, and we will see if these companies are under or overvalued. Because buying a stock of a good company is good, but buying it at a much better price is very good. And if you like such type of content, please do subscribe to my channel. So without any further delay, let's get started. The first stock on our list is Simon Property Group, ticker symbol SPG. Simon Property Group is from the real estate sector. It is a real estate investment trust that owns many of the premier shopping centers meant for shopping, dining, and entertainment purposes. Seven Property in the last month announced a dividend increase of 3% and also authorized a stock buyback for $2 billion. Looking at the company basics, Seven Property has a market cap of $42.23 billion and has a trailing 12-month yield of 6.82%. Year to date, Simon Property has taken a real beating, falling almost 32%. The last 1 year, almost 18%. From a dividend perspective, Simon Property has been growing its dividend just for the last 1 year because, just like many other REITs, it had to slash its dividends due to the COVID pandemic. It has a 5 year dividend growth rate of 2.9%. The ex-dividend date for Simon Property is June 8th. That is when the newly increased dividend will come into picture for $1.70. Tracker Dividends gives Simon Property a dividend score of 39 and considers it overvalued by almost 14%, the fair value of $94.85. But as per my dividend theory calculations, which considers the current price, the historical yield, and also the forward-looking yield, I calculate Simon Property to be undervalued by 6% with a fair price of $116. So there's not much an upside left at this moment. But if you do see a downturn in Simon Property from here, the valuation will get much cheaper and will come into a good buy point. The next company on our list is Flowers Foods, ticker symbol FLO. Flowers Foods produces and markets packaged bakery products in the United States. Few of the brands that Flowers Food owns is Nature's Own, Dave's Killers Bread, and likewise there are many other brands that it owns. Flash Foods had recently announced a dividend raise of 4.8%. Looking at the basic numbers, it has a market cap of $5.62 billion with a current forward yield of 3.37% and a PE of 20.92. Year to date, Flash Foods has fallen 5%, which means it has held much better compared to the broader market, which is the case with many of the consumer staples companies till year to date. The last 1 year, it has returned 2.6%. In the last 5 years, almost 41% return. So, from a dividend standpoint, Fast Foods has been raising its dividend for the last 8 years. The 5 year growth rate is 4.59%. The payout ratio is a tad higher, almost 67%. Like Simon Property earlier that we saw, even Fast Foods has an ex-dividend date of June 8th, which is when the newly increased dividend of 22 cents per share will come into picture. Tracker Dividends gives Fast Foods a dividend score of 63 and considers it undervalued by 15.65% with a fair value of $30.93. But as for my calculations, I found Fast Foods to be actually correctly valued at the moment. The fair price is $26.11. So any dip in this company's price from here on will make it an attractive buy point. The third stock on the list is UGI Corporation, ticker symbol UGI. UGI is from the utility sector and operates natural gas and electric utilities in Pennsylvania. It is one of my favorite utility stocks, which I personally own in my portfolio. UGI in the last month had announced a dividend raise of 4.3%. Looking at the numbers, UGI Corporation has a market cap of $9.3 billion and currently yielding 3.33% with a PE of 14.8. Year to date, UGI has fallen 5.35%, but in the last month it has risen tremendously, giving a return of almost 25%. But it's still trailing in the last 1 year by almost 7.5%. From a dividend standpoint, UGI has been growing its dividends for the last 18 years at a 5 year growth rate of 7.75%. So the recently announced 4.3% falls short of the 5 year average. It has a payout ratio of 52.47%. UGI has an ex-dividend date of June 14th, which is when the newly increased dividend of 36 cents per share will come to picture. Tracker Dividends gives UGI a dividend score of 95 and considers it undervalued by almost 42% with a fair value of $74.39. But as per my calculations, I found UGI to be undervalued by 13% with a fair price of $49. So UGI still has some space left to grow before it turns overvalued. So I will look to add UGI as much as possible as long as it is undervalued. The fourth stock on our list is Chubb Limited, ticker symbol CB. Chubb is from the financial sector that provides insurance products. Chubb recently announced a dividend raise for 4%. Looking at the basic numbers, Chubb has a market cap of $89.42 billion, having a current yield of 1.59% and a PE of 13.74. Year to date, Chubb has returned almost 9%. The last 1 year, more than 20%. And the last 5 years, almost 45%. From a dividend standpoint, Chubb has been growing its dividends for the last 13 years at a 5 year growth rate of 3%. So the recently announced dividend raise of 4% slightly outdoes the 5 year growth rate. The payout ratio is very good at just over 23%. Chubb has an ex-dividend date of June 16th, which is when the recently announced dividend hike of 83 cents per share will come into picture. Tracker Dividends gives Chubb a dividend score of 62 and considers it undervalued by 17.72% with a fair value of $253.44. But as per my calculations, I actually found Chubb to be overvalued by almost 29%. The fair price comes out to be $149. So I would safely stay away from Chubb at this moment. The next stock on our list is Medtronic PLC, ticker symbol MDT, which is from the healthcare sector. Medtronic develops, manufactures, and distributes medical instruments and equipment to hospitals worldwide. Medtronic recently announced a dividend raise of 8%. Looking at the basic numbers, it has a market cap of $131.08 billion and has a current yield of 2.85% at a PE of 17.16. Year to date, Medtronic has fallen 10%. In the last 1 year, almost 22.5%. From a dividend standpoint, Medtronic has been raising its dividends for the last 43 years. That makes it a dividend aristocrat. It has a 5 year growth rate of 7.94%. So the recently announced 8% hike is in line with its 5 year growth rate. The payout ratio is good at almost 45%. Medtronic has a ex-dividend date of June 23rd, which is when the new dividend of 68 cents per share will come into picture. Tracker Dividends gives Medtronic a dividend score of 80 and considers it undervalued by 20.47% with a fair value of $120.05. As for my calculations, I found Medtronic to be undervalued by 27% with a fair price of $121. So Medtronic is an extremely undervalued healthcare company, and I personally own this in my portfolio. And looking at such undervaluation of almost 27%, keep adding more as long as it is undervalued. The next stock on our list is Ralph Lauren Corporation, ticker symbol RL. Ralph Lauren is from the consumer discretionary sector. Ralph Lauren is an apparel company that designs, markets, and distributes products all over the world. Ralph Lauren recently announced a dividend rise of 9%. Looking at the basic numbers, Ralph Lauren has a market cap of $7.29 billion with a current yield of 2.61% at a PE of 12.57. Year to date, Ralph Lauren has fallen 13%. The last 1 year, it has fallen over 13%. The last 5 years, it has returned almost 52.5%. From a dividend standpoint, Ralph Lauren actually hasn't grown its dividend in the recent years because it had a suspended dividend during the COVID pandemic and had just started back its dividends last year. The 5 year growth rate is 6.58%. So the recently announced 9% dividend is better than the 5 year growth rate of 6.58%. The payout ratio is good, almost 33%. Ralph Lauren has an ex-dividend date of June 30th, which when the new dividend amount of 75 cents per share comes into picture. Tracker Dividends gives Ralph Lauren a dividend score of 41 and considers it undervalued by 33.36% with a fair value of $157.84. But looks like this number is not correct because as per my calculations, even I have Ralph Lauren to be undervalued by 33.38%. So it's almost same as what Tracker Dividends has given. And when we do the math, the fair price comes out to be $140.30. The next stock on the list is Deere and Company, ticker symbol DE, which is from the industrial sector and manufactures and distributes various agricultural equipment worldwide. Deere had recently raised its dividend by 8%. Looking at the basic numbers, Deere has a market cap of $110.36 billion at a yield of 1.25% with a PE of 15.6. Year to date, Deere has returned over 3%. In the last 1 year, it just held positive 0.158%. In the last 5 years, though, Deere has returned amazing, almost 189%. From a dividend standpoint, Deere has been raising its dividends for the last 4 years at a 5-year growth rate of 11.03%. So the recent raise of 8% falls short of the 5-year growth rate. The payout ratio is good at almost 22%. Deere has an ex-dividend date of June 29th. That's when the new dividend of $1.13 comes into picture. Tracker Dividends gives a Deere a dividend score of 61 and considers it undervalued by 19.07% with a fair value of $446.06. But as per my calculations, I found Deere to be overvalued by 18.2% with a fair value of $295. So at such high valuations, I would stay away from this company at the moment. The eighth and last company on our list is Lowe's Companies, ticker symbol LOW. Lowe's had recently announced a monster dividend raise of 31%. That's huge. Lowe's is a home improvement retailer and is from the consumer discretionary sector. Looking at the basic numbers, Lowe's has a market cap of $125.35 billion, currently having a yield of 2.15% at a PE of 14.43. Year to date, Lowe's has taken a real good beating, falling almost 24%. In the last 1 year, it has returned almost 3%. In the last 5 years, though, Lowe's has returned pretty well, of almost 149%. From a dividend standpoint, Lowe's has been raising its dividends for the last 58 years. That not only makes it a dividend aristocrat, but also a dividend king. The 5-year growth rate is 17.98%. So the recently announced 31% is well and above the 5-year growth rate. The payout ratio is amazing at just over 26%. Lowe's has an ex-dividend of July 19th. That's when the new dividend of $1.05 comes into picture. Tracker Dividends gives Lowe's a dividend score of 96 and considers it undervalued by 46.3% at a fair value of $363.94. But as per my calculations, I found Lowe's to be undervalued by 26% with a fair value of $246. Lowe's is an amazing company to hold in one's portfolio. It keeps churning out amazing dividend raises. If you look at the rates that was last year, even that was over 33%. Now we can't expect Lowe's to be raising its dividends every time by over 30%. Even if it manages to raise by say 10 or 15%, that would be amazing. I own it personally in my portfolio, and given it's undervalued by 26%, I'll just keep adding it as long as it's undervalued. So these are the list of companies which we just discussed that raised their dividends recently. So as we can see, a couple of them here are overvalued. That's Chubb and Deere. Fast Foods is currently rightly valued, and the remaining give an option to add to our portfolio, like UGI Corp, Medtronic, and Lowe's, which I have in my portfolio, and I will look to cash on the current undervaluation. Like I said earlier, I would stay away from Ralph Lauren at the moment. Hope you like this video, and I would really appreciate if you could hit on that like and subscribe buttons and share this video to your friends, and that would greatly help the YouTube algorithm. So until we meet in our next video, let's try as much as possible to be financially healthy. See ya. Bye.